So to answer our first question, how did Well achieve this much growth? One obvious answer is just pure timing and luck. After all, they are a high-growth digital health company during a period of historically low interest rates and a never-ending pandemic. That makes sense. I mean, just look at Moderna, whose stock price grew by 15x since Jan 30, 2020. However, while it is true that Well did hugely benefit from the pandemic, having tripled its value since Jan 31st, 2020, most of Well's growth actually occurred before the discovery of the virus, which is what I want to dig a little deeper in. According to the research I did, I found that their growth basically boiled down to three things: connection, vision, and management philosophy. In fact, when I showed this clip, I left out a very important member of Well Health's team. That member is none other than the Chinese billionaire Sir Li Ka-shing, the 30th richest man in the world, who basically bailed them out of bankruptcy and helped put them on the map. In fact, if you look at Well's stock chart, you'll see that Li Ka-shing continuously invested in Well even as it rose higher and higher in price, which really gave a boost of confidence to the public. However, one thing to note is that the Chinese billionaire only made 4 rounds of investment starting on May 15, 2018 and ending on August 15, 2019. In the subsequent rounds of financing, Well's news release indicated that they were led by Li Ka-shing, but it's a bit misleading because he didn't put any of his own cash into Well. Basically, the guy invested a total of $4 million at a 38 cents cost basis and convinced a bunch of institutions to buy in at higher prices than he did and turn his $4 million into $60 million as of November 28, 2021. The second reason Well grew so fast was thanks to Hamid's ability to communicate the company's vision.
I'm personally the largest shareholder today. I've spent personally about $5 million to buy my stake, and I'm taking my compensation in stock. I really believe in where we're going as a business. It's just academic, right? I mean, you have this incredible country with a lot of positives about its medical system, affordability, accessibility, but this digitization is lagged behind, and it's not going to lag behind forever, and it needs companies that are disciplined and focused on bringing together some of those assets, and we think it's a perfect time to be investing in this asset class.
Hamid has stayed true to his word. In fact, according to their management information circular filed on June 3, 2021, Hamid is the only senior manager who refused to take a salary and only paid himself in shares to stay 100% aligned with shareholders, which brings me to my next point: management philosophy.
I feel just that the capital allocation roots of the company are really key, and I think very important part of who we are and what we are and why you would invest in us. So if you want to learn about what capital allocation is, a lot of people talk about that. What does that really mean? You can read a great book that is a bit of a classic and favorite amongst Wall Street elites. It's called The Outsiders by William Thorndike.
To give you a bit of context about what he's talking about, Sven Carlin, who is another YouTuber with a PhD in finance, outlined 5 different business models that have historically increased share price by 10 to 100x, and one of those models is the often overlooked capital allocator model. This is a business model that was popularized by William Thorndike in his 2012 book The Outsiders, which was on Warren Buffett's #1 recommended reading list in his annual shareholder letter, and quoted by Bill Ackman as one of the most important books he's ever read. Basically, the book is a little outdated today with the rise of CEOs like Steve Jobs, Jeff Bezos, or Elon Musk, but it was written in a time when the greatest CEO of all time was considered to be Jack Welch, who ran GE, which returned investors 48 times their invested capital on a per-share basis over 20 years. He was known to use a very hands-on management style, constantly running around meeting Wall Street analysts and enforcing the Six Sigma concept, which is basically just another word for quality control. Instead of following the conventional wisdom of the time, William Thorndike studied 8 CEOs who lived in the same time but outperformed Jack Welch on a per-share basis. Each of these CEOs operated in a different industry, ranging from conglomerates, media, defense, television, newspaper, restaurant, movie theater, and whatever industry Warren Buffett was considered to be in. These 8 CEOs returned shareholders 30 to 6,000 times their invested capital over their lifetime, And the author discovered a surprising pattern where each CEO ran their business using a very similar management philosophy, which he called the outsider approach, or what is now sometimes referred to as the capital allocator model. But what exactly is capital allocation? Basically, it's the idea that the best way to increase a company's share price is by controlling where the company's capital is being allocated. Let's say you build a company, it's worth $1 million. In the first year of operations, it generates $100,000. Capital allocation is basically asking yourself, what should you do with this 100K? And I know what some of you are thinking, that new Lambo is starting to look really nice, eh? I mean, just wait another 3 years and... Hey, stay focused. Essentially, there are 5 ways a company can spend its money. They could reinvest it into their existing operations to improve their future cash flows. They could acquire another company. They could repay their debts. They could issue out dividends to their shareholders. Or they could buy back their own shares and burn them to remove them from the circulating supply. That's it. Those are the only 5 ways capital can be allocated. Okay, I know what some of you are thinking. Those are not the only 5 ways to use capital. I mean, you could just do like me and buy SPY puts with 1 days to expiry on leverage. Or what about converting your entire balance sheet to Dogecoin? While those are technically other ways you could allocate your capital, they introduce new risks which are unrelated to the company's objectives, so we don't actually consider those, unfortunately. So out of these 5 options, how do you know which one to select? Basically, you'd have to run the numbers and see which one provides shareholders the highest return. In this made-up scenario, the best option would be to reinvest into existing operations. And that's pretty much it. I know this sounds very simplistic, but what actually ends up happening is that most companies will end up paying dividends, which are very tax inefficient just because everyone else is doing it. As a result, in the long term, a good capital allocator will always outperform a bad one on a per share basis. In fact, if we go back to our 8 CEOs, each CEO significantly outperformed their industry through better capital allocation. For example, Henry Singleton returned 20.4% annually, while the industry he competed in, conglomerates, only returned 11.6%. For Tom Murphy, that number was 19.9% compared to the media industry's 13.2%, and so on and so forth. Okay, now assuming we believe that capital allocation can generate insane returns, the billion-dollar question is WELL Health Technologies a good capital allocator? The honest answer is, maybe. From the 5 available options, we know that WELL has been acquiring very aggressively in order to achieve their vision of digitally unifying the healthcare system. On the one hand, their acquisitions have significantly improved their free cash flows, which has gone from negative to positive 9 million in the trailing 12 months. To add a bit more precision and comparability, I divided this figure by their total outstanding shares, which shows that each share generated 4 cents of free cash flow. On the net income side, however, they reported a significant decrease in net income. Once again, after converting these to a per share number, we see that they had negative 14 cents in net income per share. This looks very bad, but it was actually due to a one-time non-cash amortization of professional service agreements related to their CRH medical acquisition. So if we add back this one-time non-cash expense, their net income is actually growing. But honestly, no one is really buying WELL Health at $5 just to get 0.4 cents of net income. Instead, WELL is viewed more as a high-growth tech company, which rely more on total revenues. From this standpoint, WELL is doing very well, having significantly increased the revenue per share, as we saw in my previous part 1 video where I showed this table. And here's a little update as of December 27, 2021. Basically, their revenue per share is doing even better today, while their share price has been dropping for reasons I'll dig deeper into in my next video. Another metric that WELL uses a lot is adjusted EBITDA. This is basically net income after adding back a bunch of items like depreciation, tax, interest, rent, stock-based compensation, etc., as you can see in this table. Once again, I divide by their outstanding shares and we can see that they have significantly improved their per share metric. So at least we now have a partial answer. They have very little to no free cash flow and net income, but a nice growing revenue and adjusted EBITDA. But does that make them a good capital allocator though? To help gain another partial answer, we can take a closer look at Henry Singleton, one of the 8 CEOs who ran Teledyne Technologies, a conglomerate which returned investors 181x over 28 years, representing a compound annual growth rate of 20.4%. Teledyne had 3 distinct capital allocation stages, but the most relevant is their acquisition stage from 1961 to 1971. Conglomerates like Teledyne were seen as tech companies of the time, with PE ratios ranging from 20 to 50. Meanwhile, non-conglomerates could trade at PE ratios below 12. This was a huge arbitrage opportunity since at their peak, each dollar that they raised could generate 4 times the company's own earning potential. In the span of 10 years, Teledyne made 130 such acquisitions, all with PE ratios below 12 by diluting their own shares but still increasing their EPS. As a result, Teledyne sales per share increased by 14.8x and their EPS increased by 66.2x within 10 years. Let's now compare this to Well, who are pretty much in the exact same stage as Teledyne in the 60s. However, since Well had a negative PE ratio, I changed the metric to a price to sales ratio. Then, I looked at Well's acquisition in 2021 to stay a bit more relevant. Well's price to sales peaked at 6.9 on July 5th, 2021 and fell as low as 2.3 on December 31st, 2021, which was calculated based on their market cap divided by their revenue run rate. This is our baseline we can use to assess their allocation of capital. Well's 4 largest acquisitions included CRH Medical, MyHealth, Wisp, and IntraHealth, which represented over 90% of all their 2021 acquisition by market cap. After crunching the numbers, we can see that each of their acquisitions were bought at a PS of 2.5, 2.7, 2.6, and 2.1. This shows that Well has been issuing out shares at high valuations to make acquisitions into companies with lower valuations, which is basically the same strategy as Henry Singleton, but using revenue per share instead of net income. As a result, this strategy explains how Well managed to increase their revenue per share the way they did. So, is Well Health actually a good capital allocator? They're definitely using a modified approach using revenues instead of free cash flow or net income, which still creates a lot of risk. But at least we now understand a bit better their approach to capital allocation. To help gain one final partial answer, the book also found that all capital allocators followed very similar management principles, which you can find on table 9.1 of their book. I rearranged it to look a bit nicer, and here are the book's summarized principles. Each of the 8 CEOs were first-time CEOs, they paid little to no dividends, they bought back at least 30% of their own shares, they made large acquisitions valued at least at 25% of their own market cap, they decentralized their operations, they preferred never giving Wall Street any guidance, they used an idiosyncratic metric to measure their own performance, and they focused on tax minimization. Let's now add Hamid to the list to see how he performs. The first 4 are very straightforward. Hamid is not a first-time CEO since he previously ran TO Networks, Well Health does not pay any dividends, they have not bought back their own shares, and their entire market cap is pretty much a result of acquisitions. Here's what Hamid had to say about the 5th point, decentralization.
We're trying to empower those leaders to continue to run the company in the way that they want to run the company. And that's a really big part of Well and how we do things, is that we, to a great extent, respect and delegate responsibility in terms of governance of the company to them.
As for guidance,
capital allocators, if they're really true to form and they're dedicated to being good capital allocators, they don't usually provide guidance, which is kind of like an interesting counterintuitive point. And the reason why they don't do that is because they want to be perfectly opportunistic. They want to make sure that if there isn't a good deal out there, that they don't do any acquisitions. Because listen, if I were to give you guidance or analyst guidance and I said, hey, next year we're going to buy 2 companies and the year after that we're going to buy 3 companies, I'm already signing up to do something that I have to do because I said I would do it. And that's the key about, creating, trust with the capital markets, is if you say something, you have to do it. Well, what if there are no good deals? What if I can't find any good deals to do next year? Now I've just, put myself in a position where now I have to do something that's outside of my discipline. And that's when things start falling apart. So Well is really committed to that discipline. And that's why it doesn't provide guidance. And that's why, we generally want the weighting of the business to be more tech oriented, but we will allocate capital in businesses and business units at Well that drive the best return on capital invested.
For idiosyncratic metric, Well uses adjusted EBITDA and revenue per share, as we saw previously. Finally, for tax focus, Well has a negative net income, so they are pretty much operating tax-free. So let's add back everything to the table and tally up everything. Hamid gets a score of 6.8. He's just missing being a first-time CEO and issuing stock buybacks, which could very likely happen in the future if Well manages to increase their cash flow per share. So in summary, they have strong connections, they're led by a charismatic CEO with a powerful vision, and use a, let's say, slightly modified blueprint of a money-making business model. This obviously means that they'll be successful, right?